Hi there, Millen Livis is here, your holistic financial independence mentor. Welcome to part 3 of the mini training series, Investing in the Stock Market Using Index Funds. Today we'll talk about the cost of investing when you use index funds. But first, a quick review. In part 1 of this mini training series, we talked about some good reasons to invest in the stock market using index funds. In part 2, I shared with you the 5 reasons for not investing with index funds. What is inexpensive when you use index funds? One of the main advantages of investing in the stock market using index funds is low cost of this type of investing, because index funds are not actively managed mutual funds. They simply replicate the return on specific market indexes. This type of investing is considered passive. Index funds portfolio managers merely buy and hold a sample of the stocks in the target indexes, and then they leave them alone unless the index itself changes its components. In other words, portfolio managers are not actively stock picking holdings in the index funds by buying and selling the securities inside it. And so because of the low hands-on management involved, index funds have below average expense ratios, unlike actively managed mutual funds. And index funds are referred to as low-cost investing option, which many investors like. So let's define low cost of investing by looking at financial metric like expense ratio. An expense ratio reveals the amount that an investment management companies charge investors for managing investment portfolios, a mutual fund, or an exchange-traded fund. The expense ratio represents all of the management fees and operating costs of the fund and shows the percentage of expenses compared to the amount of annual average assets under management in the fund. Expense ratios are listed on the prospectus of every fund and on many financial websites, so you can always find the expense ratios. And by the way, competition has led expense ratios to fall dramatically over the past several years. What are the high and the low expense ratios? A number of factors determine whether an expense ratio is considered high or low. A good expense ratio from the investor's viewpoint is around 0.5% to 0.75% for actively managed portfolios. An expense ratio greater than 1.5 is considered high. Very good point to remember. In other words, the average expense ratio for actively managed mutual funds is between 0.5 to 1% and occasionally up to 2.5%, which is high. For passive index funds, the typical ratio is about 0.2% or even lower. So besides index funds, you can also choose to invest in the stock market using ETFs, exchange-traded funds, which are not mutual funds, that's why I like ETFs. ETFs are also passively managed funds, and unlike index funds, they trade throughout the day, similar to stocks, okay? While index funds trade once at the market close. In general, the expense ratios for mutual funds, including index funds, are higher than expense ratios for ETFs in general. In other words, ETFs are often cheaper than index funds if both commission-free, which many brokerages offer now. Also, index funds sometimes have higher minimum investment amounts than ETFs. However, some fund providers in the US, like Fidelity Investments or Vanguard Group, offer minimum investments on the index funds. Okay, so we covered that. Next, let's talk about understanding the hidden differences between index funds, between different index funds. it may be reasonable to assume that the index funds that track the same indexes should all have the same performance, right? However, there are many disparities across different index funds, primarily because of the different operating expenses and therefore different expense ratios. Expenses are very important to consider when you invest in the stock market because they can erode your return on investment. Next, let's talk about fees. Index funds with nearly identical portfolio components and investing strategies can have completely different fee structures. Some index funds charge front-end load, which are basically commissions or sales charges applied upfront when the initial purchase of an investment happens. Other funds charge back-end loads, which are charges and commissions that occur when investment is sold. There are other fees like, for example, 12B-1 fees, which are annual distribution or marketing fees for the fund. So the fees and expense ratio, when taken cumulatively, can dramatically impact the investor's return over time. So various fees along with the expense ratio should be considered before buying an index fund. Typically, larger, more established funds tend to charge lower fees. Why? Well, let me give you an example. Vanguard 500 Index Admiral Shares Fund, which tracks the stocks of 500 of the largest US companies, charges only 0.04% expense ratio, which is very, very low. So the lower fees could be the result, as I mentioned, of big companies why they charge lower fees, because management expenses, management experience in tracking indexes, so it takes less time for them. Also, a larger asset base. They have larger accumulated asset that they manage, which could enhance the ability to use what is called economies of scale in purchasing the securities. Economies of scale are cost savings and advantages gained by large companies when they buy in bulk. Therefore, they can lower the cost per unit. Okay, so what is inexpensive when we use index funds? Here's the bottom line. A reasonable expense ratio paid to funds managers for an actively managed portfolio is about 0.5 to 0.75, while the expense ratio is greater than 1.5% is considered high these days, okay? For index funds, which are not actively managed mutual funds, the typical ratio is about 0.2%, but can be as low as 0.04%, as I shared with you, or sometimes even less than that. So, like with most things, you often get what you pay for, right? We know that saying. However, in the world of investing, there is evidence that low-cost passive index funds often outperform actively managed portfolios, especially after accounting for fees, expenses, and taxes. That's all I have for part 3 of this mini training series. If you have any questions about this training, go ahead and post them in the comments. Next week, I'll share with you the part 4 in this mini training series, where I will talk about 4 potential warnings about index funds. Remember, everything has the front and the back. And if you want to discuss your specific financial goals or concerns with me, book your Never Worry About Money Again complimentary consultation. Here's the link for that. And yeah, that's all for today. Thank you so much for watching. Thank you for your time, for your attention today. Stay blessed. Stay in your power.